When people talk about risk in financial markets, they usually point to one number: volatility. If volatility is high, the asset is labeled as risky. If it's low, the asset is often considered safe, stable, or predictable. But this way of thinking is incomplete, and in many cases, it leads to conclusions that are simply wrong. To understand why, we need to be precise about what volatility actually measures. Volatility looks at how much returns fluctuate around their average value over time. It doesn't focus on direction. It doesn't care whether those movements are gains or losses. It only measures how spread out the outcomes are. Mathematically, this is captured by the standard deviation of returns, a measure of dispersion, not risk in the intuitive sense. Now, imagine two different assets. Over the long run, both of them generate the exact same average return. But if you zoom out far enough, they end up in the same place. But the way they get there is completely different. One moves steadily with small consistent changes, while the other one moves erratically with sharp jumps up and down along the way. The second high asset has a higher volatility because its returns deviate more from the average. Those deviations, both positive and negative, are exactly what volatility captures. And this is a key point. Volatility treats upward and downward movements the same way. A large gain increases volatility just as much as a large loss. This leads to an important and often overlooked consequence. An asset can have a high volatility and still perform very well over time. In fact, many high-growth assets are also highly volatile. At the same time though, an asset with very low volatility can steadily lose value, drifting downward in a smooth and seemingly stable way. So, low volatility does not always guarantee safety, and high volatility doesn't automatically mean danger. This is where the most common definition of risk starts to break down. Volatility doesn't tell you the probability of losing money. It tells you how large potential losses might be. And it doesn't distinguish between good outcomes and bad ones. It simply measures how widely returns are distributed around their average. Despite all of this, however, volatility remains one of the most important quantities in quantitative finance. It plays a central role in option pricing models where it directly influences the value of uncertainty. It's also used in portfolio construction and risk models, where it helps quantify how much an asset's return can vary over time. But in all of these cases, volatility is just one input among many, not a complete definition of risk. To truly understand risk, we need to go much further. You need to look at the full distribution of outcomes, the likelihood of extreme events, the behavior of returns over time, as volatility gives you part of the picture, but not the whole story. And if you rely on it alone, you're not actually measuring risk, you're just measuring the noise.